Thanks so much for tuning in to this conversation. You could argue that it's an earnings conversation, but it's not, because the earnings happened last week. The idea of doing this conversation with Mr. Ram was to try and understand what goes behind putting in a quarterly performance of this nature in a sector which is not so easy, but a sector which has got tailwinds to itself. So Cummins, revenues were up 25%. EBITDA, though, went up to nearly 51.5% growth. EBITDA margins expanded nearly 400 basis points, if I'm not wrong, and it therefore saw a net profit growth of about 65%. I didn't see too many segmental issues as well with the kind of numbers that they clocked in. So let's get in Mr. Ashwath Ram to try and understand what's playing out on the ground. How long can the party last, if it can, and what are the what is at interplay here to take the numbers higher? Mr. Ram, good having you. Thanks for joining and hope all is well.
Thanks, Neeraj. Everything is well. I think three major variables came into play in this quarter to help us achieve these numbers. One is that demand stayed strong, and so we were able to leverage the cost base to get better results. We also delivered better. The second is that we had taken price increases because of the inordinate commodity increases over the last 18 months. And so we held on to those price increases. And the third is that we did see some kind of softening in some of the commodities over the last couple of quarters. And so we were able to take advantage of that. So it's a combination of those three variables and then holding on to tight cost structure, which has enabled us to get better results. Talking about how we think whether this is sustainable, I think it's sustainable. Like you rightly said, most segment indicators appear positive for India, at least right now. And so if those continue and some of these geopolitical things that are happening around the world, if they don't derail the global economy, I think this kind of performance is sustainable.
What are client conversations suggesting? Are all of your key segments seeing decent traction, appetite, and conversation, or some are doing better than others and some might actually be worse off as well?
See, some segments have been in a recovery mode. So not all segments are firing at 100 or 120%. Some segments have been lagging. So construction, for example, is one segment where even though we are spending a lot of money on building roads, infrastructure, that has not actually flown into the ground, into the projects as yet. And so if you look at the numbers in the construction segment over the last 2 or 3 quarters, they have been lagging. As a matter of fact, they have underperformed to our own expectations. And other segments like power generation have performed better than our expectations, primarily because the growth in telecom, in data centers, in residential realty, which is bounced back, in manufacturing, in infrastructure related projects related to commercial buildings as well as ports, etc. Those activities continued at a very good steam. So it's a mixed bag. So if I talk to mobility customers have had a downturn since 2019, and 2020 and 2021 were COVID years. So they are just seeing a bounce back from artificial lows for 3 years. So they are starting to see a bounce back in 22, and they think it can sustain into 23 as well. So it's a mixed bag is what I would conclude as far as optimism across different market segments is concerned.
There is a lot of focus on infrastructure and construction. Is this a typical behavior that maybe at the start of a cycle, if we are at that things don't start reflecting very soon, but when they do, they kind of reflect in a hurry? Is this what typically happens?
Yeah, I would like to draw attention to what the world has seen in countries like China or in South Korea or even in parts of the United States. When those economies began growing, they began by building infrastructure very strongly. Built roads, built airports, built highways, built rail. And when that happened, they were able to sustain multi-years of growth. So China between 1990 and literally 2015 had 20-25 years of straight growth, fundamentally driven by building base infrastructure around their own country. So if we are able to do that, I'm not saying we could do the kinds of things China can do just because of the way they are governed versus the way India is governed. But I think if we can maintain a +7% growth in our GDP over multiple years, I think we should see similar kind of growth in India as well.
Okay, well, hopefully that happens. Now, I reckon that both product mix as well as operating leverage would have driven the margin surprise, you would reckon? And how does this scenario therefore shape up ahead?
One thing, Neeraj, is we are still delivering product in a constrained manner. So we are not, even today, we are not delivering 100% of our demand because we still continue to be constrained by supply chain, mostly electronics, but there are also some specialized items related to rubbers, related to silicon, some kinds of special materials, which are still available in a constrained manner, driven by the geopolitical situations in Ukraine or the COVID shutdowns in China. So those continue to be constrained. So the numbers you're seeing still are not the complete market's unconstrained demand. We think that that situation is not likely to improve because all of this while China economy was slowing down. And so if China economy starts to pick up as it has in this quarter, there are going to be further constraints on the supply chain, further pressure on commodity prices. So I think it's going to be wait and watch. It's going to be pretty tricky to handle the situation and the scenarios. But we remain optimistic that despite all of that, we continue to see growth opportunities.
Okay, so there are a couple of, I would love to draw your attention to a couple of points made in two notes. One of the notes says that a 30 to 50% price hike is needed to offset costs on the new engines. And that is the reason for our margin concern. How would you respond to this?
So I'll draw the experience we have when we moved from mechanical engines to electronic engines in the mobility space in a couple of our joint ventures. And when we went from, for example, from BS3 to BS4, it went from mechanical to electronic engines. At that time, one had to, first of all, add a whole bunch of electronic systems into the engine. And one also had to add after treatment, which is an entirely additional and different system, which is also made by Cummins, which was never before in the portfolio. So what happened is the base product cost almost doubled in that scenario. And in a product like a genset, the engine plus after treatment is a major portion of the cost of a genset, which is why we think that significant cost increases are there, of course, but price increases will be required just to maintain the existing levels of margins that we have. And so obviously there will be pressure from the market when that transition happens. But this has happened in multiple markets around the world. When one goes from a very straightforward, commoditized kind of technology to a very, very competitive and sophisticated technology, there are those cost transitions which happen, and then everyone gets used to it, and then it's business as usual.
So would it require 30 to 50% price rise?
Yes, depends on the node, depends on how much of content goes in. So okay. Yes, it's like
and you reckon the market will have the capacity to absorb this?
It happened in the automotive industry, and they absorbed it. What typically happens is people worry, they do a pre-buy, and you get a lot of demand for older products, and then this is an essential product required to back up and run your daily life. So eventually people get accustomed to it and it moves on.
So, Ram, one last question on this. Would you reckon comparisons to a previous cycle, let's say, if again, one more note says that for Cummins in particular, despite FY16 and FY19 showing very strong growth, in that period of 5 years, your margins did come off as well. So it could this time be different in that you might have growth, but you might not have to compromise on margins, or would you probably need to compromise on margins a little bit?
We think see when in the CPCB-II cycle, what happened is it moved from a mechanical product to a mechanical product. The mechanical product had been in existence for 40 years, so it was already commoditized. And then we were able to eke out one more cycle with the mechanical product. So it was already a commoditized product which was under margin pressure. So we were not bringing anything very significant to the market by which we could product differentiate and then have greater margins. We think that with this cycle, we are bringing a lot more to the table. Of course, we are launching many new products, but we are also differentiating on the product in terms of product density. We would offer some of the best product densities the market has in the system globally. And we think that will help us at least retain and maintain margins. That's at least what our ambition is.
Very interesting. Now, when I look at the segments, almost all segments are kind of sunrise themes. They are seeing green shoots. There is a government backing coming there in order to promote these as well. Where is it that you believe the highest rate of growth could come in? And where is it that you believe there is growth longevity? I'm just trying to understand for Cummins and for the space at large.
Certainly in the core infrastructure related to data and telecommunications. So as we move towards 5G and rollout of 5G in India has started, the amount of data consumed per consumer goes up by a factor of almost 10x. Already you've seen during the COVID time that people were able to get their lives in order and do work normally despite working out of home. And people also saw during that time that the consumption of media, consumption of data, consumption of telecommunication went up by almost 2 or 3 times. So when now you have a multiplying effect because you're pumping so much data through the system, you need to store that data, you need to organize that data, you need to back up the information, you need power to intermediately store the information before it is sent to other locations, etc. So and we are at a nascent stage in India, so I think there is a lot of opportunity for the next 4 to 5 years at least for that segment to keep growing. The fundamental infrastructure related segments, which we spoke about earlier, if the GDP does continue to grow at this plus 7% rate, then we are going to keep building more bridges. We're going to keep building more roads, and so construction should pick up again. Construction should boom actually, and similarly. It augurs well for related segments like mobility holds well for mining. We mine iron ore, we mine coal, and many of the companies, big companies in India have announced plans to almost double their output capacity, for example, for steel. So if you're doubling the amount of steel, you need double the amount of coal, or you need double the amount of iron ore. So some of those related segments also can see positive growth as we move forward.
Last question really, or last couple of questions, maybe the last question, would a Western slowdown be of immense worry to you, Ram, or would you reckon that India will still maybe escape that velocity of downtick, and therefore business, even if it doesn't boom, will still be okay?
See, for the Cummins Group in India, about 30% of our revenue for the overall group comes from exports. So even if India, keeps doing well, but if there is a global slowdown, that portion of the business which is also growing well and which we feel is entitled to become even a bigger share of our revenue could take a hit. So certainly we would worry about that. We are hedging our bets by launching many more products and localizing many more things, making ourselves cost competitive to work in the global market and work on market share, even if demand from growth slows down. So that's the way we are trying to hedge our situation. But certainly, if there's a global economy slowdown, India gets impacted by it one way or the other.
Thanks for the candor. But just wondering, I mean, the order inflow is not a worry at all, right, Ram? I mean, it's looked okay. You reckon it'll continue to look okay?
It's holding steady for now. So it's not a worry till for the next couple of quarters, and then beyond that, it's a little difficult to predict what's going to happen. But we remain cautiously optimistic.
Well, we wish you much more than that. Congratulations on a good show and all the best for the quarters ahead.
Thank you, Neeraj. Thank you.
Lovely talking to you. That's Mr. Ashwath Ram of Cummins talking about how things have shaped up in what was a very strong quarter 3 for them. And hopefully things will continue to look well. Viewers, thanks for tuning in.